Thank you. Our first question comes from the line of Laura Ng with Morgan Stanley. Please proceed with your question.
Good morning. It's Simeon Gutman from Morgan Stanley. My first question is on the macro housing backdrop and the ingredients to a 1% comp. So existing home sales look like they're set to grow mid-singles. And if that's the case, home improvement demand could arguably be a little stronger than maybe a 1 comp or whatever assumption you're using. What's your take on that? I know Richard said we're not assuming any improvement in turnover. Is there any change about your forecast due to people staying in their homes longer and rates being stubborn?
Hi, Simeon. Yes, at this point, while we've seen a little life in turnover in Q4, we're not expecting meaningful increase off that 40-year low. We've likely reached the bottom of housing turnover at about 3% of units, but we're not expecting a big rebound nor significant increases in new housing starts. However, if you just step back, I mean, if you look at our customer, they remain very healthy. We look at our customer today, we think about $110,000 average income. Those incomes have been growing. We've talked about the increase in home equity values, up 50% since the end of 19, and then wealth effect through stock market and other investments. So our customer is very healthy. And as you say, if they're staying in their homes longer, they will take on larger remodeling projects as opposed to moving, those that are locked into lower interest rates or just not wanting to get mortgages with the higher rates. But we're not anticipating a large decrease in mortgage rates. It will be more a issue of consumers getting used to these higher rates. And to take on a larger project, it's usually financed. And that financing is through HELOCs. And we've started to see a little increase in each of cash out refis as well as draws on HELOCs. But there's literally trillions of dollars of equity built up in U.S. housing. And as homes continue to age and people are staying in those homes and realize that, we're highly unlikely to see the low interest rates we saw over the past 2-3 years, that they'll eventually tap that equity and do the larger remodeling projects. We're just not sure that turn comes in 2025 at a dramatically accelerated pace.
And to follow up on the 1%, just to explain that, Simeon, obviously this is a triangulation. We look at exit run rates of the business, and as we said, keep in mind that Q4, while certainly showing signs of momentum growing from Q3, still had some benefit from hurricanes that won't fully repeat in 2025. So a slight dampening of the run rate and then the assumption of continued pressure on larger projects. With the shape of the year increasing slightly through the year, which also includes the inclusion of SRS in our comp. You'll see them in our comp for the last 7 months of the year.
Okay, that's helpful. The follow-up, if comps do end up being a little stronger than 1, does each point flow through at this 10 points of leverage to the margin? Or is there a scenario, whether it's better DIY, more pro, more complex project, or do you spend more? Is there a mix shift that could alter that relationship above 1?
No, I think look, the 10 basis points is a good rough estimate of leverage from that point.
Great. Good luck.
You're not going to have meaningful shifts in mix. Even if mix shifts, you're not going to have meaningful differences in that leverage number.
Thank you.
Our next question comes from the line of Christopher Horvers with J.P. Morgan. Please proceed with your question.
Thanks. Good morning, everybody. I wanted to go at a similar kind of question, maybe on a different angle. appliances were up, paint was up. Was that volume driven? And to what extent do you think the category was up versus Home Depot, continuing to gain share? Because as you look forward, the replacement cycle dynamics should get better from 4Q levels. You'll be 5 years out. Ted, you've talked about in the past, every wall was painted in the U.S. in 2020, but we're getting further from there. So doesn't that replacement part of the business further accelerate? And curious if you were going to say X percent of the business is replacement versus Y percent is, more like big ticket remodel, which would, we expect to continue to be an anchor.
Sure, Chris. Let me make a broad comment, and then Billy can give some detail on particular categories. Look, if we just step back and look at this quarter, we're happy with it, right? Sales exceeded our expectations, and we're happy with positive comps, obviously, for the first time in 2 years, and particularly happy with positive transaction comps, which has been negative for over 3 years. And as you say, the business has strengthened across many categories and in many geographies. In fact, we haven't seen this broader base performance in over 2 years and maybe even closer to 3 years. And if you go back, Chris, to your comment on COVID, I'd say that shift of spending back to services post-COVID and the pull forward of demand during the pandemic, those have largely played out. There may be a category here and there, but I'd say that PC shift in home improvement pull forward have largely played out. And engagement in repair in smaller updates and decor-oriented updates is strengthening, and Billy can give some detail on the categories.
Yeah, listen, as Ted mentioned, the broader base performance, I talked about the 10 of the 16 departments that posted positive comps. We had an outperform, Chris, as you mentioned, in appliances in our gift center business, which, we had record sales, candidly, in those areas across the store. So we had a healthy balance of transactions and unit performance, which, to Ted's point, we hadn't seen in a while. With that said, still the pressure we know in finance projects. We had great performance across many of our pro-heavy categories. I mentioned gypsum and decking, concrete, fencing, and while there was some hurricane impact in there, we're pretty pleased with the broad base of performance, not only across the merchandising departments, but certainly across the country. But there's just no denying the deferral that we're still seeing. We are pleased with the pull forward that we think is largely, behind us at this point from a go-forward standpoint. So, all those things bode well, but still the pressure in some of the, more finance projects, we're still continuing to see that exist.
Got it. And then, Richard, can you talk about the monthly U.S. comps, adjusting for the holiday shift? There's been a lot of questions, I think, over the past 5-6 weeks on what's going on with the consumer. You saw F&D talk about a slowdown relative to what they saw in the fourth quarter, and they talked about weather. So can you talk about, do you think, that the weather had any influence on the business in January, and any comment on exit rate? Thanks very much.
I think that, so, the monthly progression was absolutely influenced by holiday shifts, again, to the benefit of December, to the detriment of November and January. But no doubt, weather was horrible in January. We've had 2 years in a row of tough Januaries, but this one was particularly tough. And so that's why we don't read a tremendous amount into it when we think about exit run rate. But no doubt, weather had an impact.
Great. Thanks very much. Have a great spring.
Thanks.
Our next question comes from the line of Michael Lasser with UBS. Please proceed with your question.
Good morning. Thank you so much for taking my question. What market share assumption have you embedded into your 2025 outlook? And why wouldn't it be reasonable for us to assume that Home Depot's market share gains should accelerate from here and be above where they've been historically in light of you now having SRS as well as many more capabilities given the investments that have been made over the last several years? Is that a sign that you think your DIY market share is starting to peak, and that could have an impact on the overall share gains for the enterprise?
Hi, Michael. Thanks for the question. As we look at the overall market for 2025, we see it overall being flat, maybe up slightly. Those expectations have come down over the last several months. And R plus one, as Richard explained, is a continuation of some of the underlying strength in the business and our initiatives that we absolutely are gaining incremental sales for us. So that's why we peg our comp growth at 1%. Now, if you look at the combination of what's driving our share gain for both pro and consumer in the core, it is all the capabilities that we're putting in the marketplace. We talked a lot about interconnected and all the investments we've made on the interconnected journey, and then certainly all the investments on our pro ecosystem. And I'll have Jordan spend a few minutes more on what we're doing on interconnected. And then you add what we're doing with SRS. SRS will grow faster than the core, and we believe they're taking share in each of their three verticals. So we're very pleased with what SRS is doing. So all that with our new stores, which are starting to add some meaningful dollars to our growth, gets us to the 1% comp and 2.8% overall growth in a flat market. So we wouldn't say our share has peaked by any means in DIY or pro. And then Jordan, if you chat about what we're doing to drive share in pro and consumer with interconnected.
Sure. So Billy shared the excitement we have had on .com sales performance, and that's really across both the consumer and the pro, both of them up healthily online. And it's been a combination of investments that we've made that have helped deliver that, from the site experience and really making that journey so much better from a browse and search perspective and finding the right product, to the fulfillment. Billy mentioned that we've had the fastest delivery speeds in the history of our company, same day delivery, next day delivery, whether that's concrete and lumber or whether that's a light bulb or a power tool. It's been really fast, and all of those investments have come together to really drive an improvement in conversion rate on the site. And then what we see is an increased engagement across channel with more purchases that come in store. So we're real excited about the momentum there and see the investments that we've made really paying off.
Thank you for that. My follow-up question is on what's been happening as of late. There's been a lot of focus on the impact that the government efficiency measures and or immigration policy implementation could have on the U.S. consumer. How did you factor that and those considerations into the guidance? And while you had just indicated that weather was really the underlying cause of some of the results in January, are you seeing any evidence that these factors are having an impact on the business? There's been talk about housing inventory in the Mid-Atlantic starting to creep higher. So anything you could provide that would be very helpful.
Michael, I don't think we've seen anything specifically. If you tick through some of the things you mentioned, and some I'd add, tax policy would be, one of the most important to Home Depot as a full taxpayer. So we'd be very pleased if the corporate rate stays at 21%. Tariffs is obviously a lot of discussion on what rates would be and what countries would be impacted and what categories of goods. We've been through that before, and I think we have the best team to manage through any tariff environment which would impact the industry broadly. I'd say our diversification efforts out of certain concentrations in countries has been quite good over the last 6 or 7 years. You mentioned immigration. We've talked about having a shortage of skilled trades folks in this country for some time. We believe it's like 400,000 trades folks short, and not sure how that number would change with any meaningful change in immigration. And then specifically to the government efficiency in Mid-Atlantic, no, we've not seen anything there.
Thank you very much and good luck.
Thank you.
Our next question comes from the line of Scott Ciccarelli with Truist. Please proceed with your question.
Good morning, guys. Dan talked about $1 billion of incremental sales in the 17 markets where you've started to build out Complex Pro capabilities. How do you actually measure that? And then what kind of ramp would you expect in those markets in 25 as you continue to phase in order management, credit expansion, et cetera, some of the other capabilities that you've discussed? Thanks.
Yeah, thank you, Scott. Yeah, as we mentioned, that we're incredibly pleased with what we've seen so far. We're generating $1 billion and growing, so that's been fantastic. And as we mentioned as well, it's geared across all purchase occasion. The way we measure that is the incremental sales in the 17 markets versus what we see in the top 40 markets. So the $1 billion of annualized sales is that in those 17 markets, we have been outperforming other top 40 markets. And so when you think about 2025, we're focused on really maturing the capabilities in these 17 markets, which is really important. Not only maturing the existing capabilities, but really, really rolling out new capabilities as well. So whether it be delivery, expanding our sales force, those are key things that we'll continue to focus on, as well as new capabilities as we talk about trade credit, order management, account management. Those are opportunities that we have to continue to grow in 2025. And Ted talked about SRS, and there's also an opportunity for us to really drive cross-selling opportunities across the SRS portfolio. Last but not least, we have more FDCs in the pipeline as well. We have 3 FDCs under construction. We have more in the pipeline. So we're incredibly pleased with what we've seen in 2024 when we think about the 17 markets across our company and compared to the top 40 markets, but more importantly, what we've seen with the pro ecosystem across the country as well, and making sure that we're doubling down on the opportunities that we see.
Appreciate that. What's the biggest sticking point as you roll this out? Is it building the specialty sales force? Is it the recognition from your complex pros, et cetera? Like, what's the toughest piece that you've kind of learned that you have to? What's your toughest hurdle you have to clear?
Yeah, Scott, this is, what we continue to find. This is an entire ecosystem, right? So it's not just one component of the ecosystem, right? When we talk about the outside sales, or we talk about delivery, or we talk about order management and account management, it's all of those things working in concert. So what, is always kind of difficult is as you roll these capabilities out, and they're at different levels of maturity, our focus is to refine and really perfect what we're seeing. And that takes time in a market, especially when you're building relationships. We don't want to create new relationships with our new capabilities with our pros and then have big failure points. So the difficult part is making sure that we're doubling down and moving at a speed that drives outcomes, but at the same time that we're focused on perfecting within the market. So it's incredibly complex. It is really important that we do this right. And in 2024, we saw some really, really great progress. And that's what makes us excited about what we will do in 2025 and beyond.
Thank you.
Our next question comes from the line of Karen Short with Melius Research. Please proceed with your question.
Hi, thanks very much, and good to talk to you. So I had one question regarding guidance and another totally irrelated. So X the intangibles in terms of operating margin guidance, so should we look at that as the right way to think about the relationship between sales growth and operating margin growth, i.e. excluding intangible impact from SRS on your guidance?
Yes, Karen, we believe that removing the non-cash amortization expense related to the amortization of intangible assets is the best way to look at our underlying operating margin. And so that's where we have guided for the last couple of quarters and will continue to guide on the basis of moving forward.
So how should we?
Karen, by the way, it includes the operating margin is adjusted for all non-cash amortization expense at the Home Depot, not just that related to SRS.
Okay, thank you. So how should we think about the relationship on total sales growth versus operating margin or operating profit growth on the way you define it?
Delevers is essentially the same when you're looking at adjusted operating margin versus GAAP operating margin. So there's no change needed in the way that we've talked about leverage or deleverage in the past.
Okay, and is 2.5% of sales the right run rate to think about on CapEx going forward?
So, historically we've said 2% is sort of a rough expectation. We have increased that percentage really to reflect two things. Number one, obviously we are happy with the investments we've made. They are generating exceptional returns, and so we're leaning into those investments. But second, a big part of that investment portfolio are our new stores. And it's worth calling our new store program out. In 2023, we announced we would build 80 stores over 5 years, including the year 2023. We are 25 stores into that program. So far, the results have been fantastic. We're tracking ahead of expectations. So we are going to continue, and we will complete that program. This year will be the third year of the program. We'll complete it by year 5, which is 2027. So that 2.5% of sales is reflective of that new store program, as well as leaning into investments that are working.
Okay, great. Thank you so much.
You're welcome.
Our next question comes from the line of Steven Zaccone with Citi. Please proceed with your question.
Great, good morning. Thanks very much for taking my question. I actually want to follow up on Karen's question there and maybe dig into the SRS contribution a bit more. Can you help us understand how that's impacting the bottom line for 2025? Because you gave the organic mid-single-digit growth for the business. Maybe how's the bottom line tracking versus expectations?
Dollars to our top line from 7 months of ownership. They hit that on the button, and we feel great about their P&L top to bottom. And so from as we discussed during the deal, we expected this to be cash accretive within the first year of ownership. We'll be coming up on that first year anniversary soon. They're already contributing to top and bottom line, and so we feel really happy about that. Now, just to be clear, to make sure that everyone understands this, obviously we report our results on a consolidated basis. If you think about the pro forma impact of SRS, the reflection of SRS and its mix impact on the Home Depot, there's about a 40 basis point full year mix impact to the Home Depot. And so think about Home Depot, in total being impacted by about 40 basis points. But that's a mix effect, and we'll take that all day long. They are leaders in their spaces. They're performing exceptionally well, and we're happy with that.
Okay, thanks. The follow-up question I had was just on maybe the pricing environment. In the past, I think you've talked about prices kind of settling. Do you feel like we're at a point now where we should see sort of a natural, return to a normal environment for pricing? And then how does the potential for tariffs kind of fit into that view?
Well, thanks, Stephen. It's Billy. Listen, as it relates to just the general pricing environment, and then I'll talk for a minute about tariffs. I mean, we are in a very rational market, just by definition, and prices, as we've mentioned on the last couple of calls, really have settled to your point, and the promotional activity is the same as it's been, kind of pre-COVID as well. So no differences in that. And as I mentioned, again, the last couple quarters, pricing is settled into the market accordingly. As it relates to tariffs, and we've spoken a little bit about it this morning. I mean, listen, we've been through this before. We'll continue to assess, how these impact our business from a go-forward standpoint. We've been focused on diversifying sourcing for several years, so we'll continue to assess that going forward. But our number one job in merchandising is to be the customer's advocate for value. We have great vendor relationships, and with our scale, we feel that we're as well or better positioned than anyone in the marketplace to navigate the environment going forward.
And actually, I want to go back one question and just follow up on Stephen's question. So, Stephen, just to put a year-over-year comparison together for you and talk about how SRS impacts year-over-year from an operating margin perspective. So as you see in our guidance, we're guiding to a 13.4% adjusted operating margin from a 13.8%. That's a 40 basis point decrease. Here's how that 40 basis points breaks down. It's coincidental to the pro forma impact, but the year-over-year is different. So that 40 reflects 20 basis points of natural deleverage. And recall, we think this business levers about a 3% comp. So at a 1% comp, we're getting about 2 comp points of deleverage. So 2 times about 10 basis points per is 20 basis points. Then the inclusion of 12 months of ownership of SRS compared to 7 months of ownership is reflected in 15 basis points of mix shift. So you've got about a 15 basis point impact of that year-over-year comparison of 12 months versus 7 months. And then finally, the comparison versus a 53-week year also shifts margin by 5 basis points. So you've got 20 bips from natural deleverage, you've got 15 from SRS impact, and you've got 5 from the 53rd week comparison. Within that, I think it's worth saying, look, we are leaning into investments. We're paying for those investments through productivity. And so that's also within that operating margin guidance. There's productivity inside it as well as leaning into investments, and I hope that makes it a little bit more clear.
Yeah, that answers our question. Thank you so much for that follow-up.
Our next question comes from the line of Seth Sigman with Barclays. Please proceed with your question.
Thanks. Good morning, everyone. I do want to follow up on that last point around the flow-through. If you step back and look at your sales over the last several years, I think since 2019, sales are up maybe 45%. SG&A is actually up a similar percent. Along the way, there have been investments and plenty of cost pressures. I guess the real question is, to the extent that comps start to improve here, they progress throughout 2025, are we at that point where sales should grow faster than expenses and you can really start to see that flow through come through?
Seth, I would point you back to our investor conference back in 2023, right? Once this market normalizes, we would expect a base case of 3 to 4% top line growth. We would expect, and within that, we expect flat gross margin as kind of a base expectation. And then we do expect operating expense leverage. And so that takes you to the earnings per share expectation of mid to high single digit growth once our market is normalized and once we're back to that level of sales growth. And that view hasn't changed since 2023.
Okay, great. Thank you for that. And then just on that point around the gross margin, you are guiding flat in 25. You still have some SRS dilution wrapping into this year. Can you talk about some of the underlying assumptions for core Home Depot and speak to the offsets that would be helping mitigate that SRS dilution? Thanks so much.
Sure. I'd point it to, you're right about that. We still have a little bit of a lap, and so there's pressure from SRS mix. Just two great call-outs. Number one, our outstanding supply chain and merchandising teams finding productivity, and I could go on and on about it, but the benefits we've seen in supply chain productivity alone are really encouraging. And we would call out our fantastic store operations team, who have now driven improvements in shrink for about a year and a half, year over year, quarter by quarter. We expect that to continue into 2025. And so it's really a story of SRS mix being offset by supply chain productivity, some other great things the merchants are doing, and our fantastic store ops team.
Thanks. Appreciate it.
Christine, we have time for one more question.
Thank you. Our final question will come from the line of Zihan Ma with Bernstein. Please proceed with your question.
Hi. Thank you so much for taking my question. Just a final quick one. How does your Complex Pro initiative impact your long-term ROIC expectations, taking into account that you are extending more trade credit and potentially holding more inventory with a broader assortment from here? Thank you.
I wouldn't expect a meaningful impact on ROIC through capital investments. We've talked about driving incremental sales and profit dollar growth. That business has a different margin profile, but certainly incremental sales and profit growth. But it's really a reasonably asset-light investment. We lease the DCs, we lease trucks, we bring on sales teams that are commissioned sales forces that sort of earn their keep as they build their portfolios. Trade credit, as we scale that, we're tiny exposure at the moment, but as we build that, it's just not going to be a meaningful balance sheet item given the scale of our overall balance sheet.
Okay, great. Thank you.
Ms. Janci, I would now like to turn the floor back over to you for closing comments.
Thank you, Christine, and thank you, everybody, for joining us today. We look forward to speaking with you on our first quarter earnings call in May.
This concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation, and have a wonderful day.